Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. The Federal Reserve cut interest rates on Wednesday, October 29th, 2025, and this was a quarter percentage point reduction, bringing the federal fund rate to a range of 3.75% to 4%. That headline made a lot of people cheer because lower rates feel like relief. But if you're keeping cash parked in a standard bank account or savings account, that relief could quietly cost you money. The national average interest rate for a savings account is currently around 0.40 APY, according to the FDIC. While inflation can erode 3 to 4% of your purchasing power on average, in some years even more than that. So on paper, you might be earning interest while in reality, you're actually drifting backwards. This video is your action plan. Over the next few minutes, we'll walk through where to move your savings and how to keep it working for you, and also how to think about investments around a Fed move without playing a dangerous timing game. The goal is simple: stop bleeding, start earning, and make decisions that will hold up for the next few years, not the next news cycle. So without further ado, let's get right into the video. The Fed controls the federal fund rate, which is the overnight rate banks charge each other. When the Fed cuts it, it becomes cheaper for financial institutions to borrow money. Cheaper money for them ripples through the system, and that usually shows up as a lower yield on your deposits. So translation, the interest your bank pays you on your checking and savings account tends to drift down after a cut. It's easy to celebrate lower borrowing costs and miss the flip side. If the cost of money falls, banks have less incentive to pay you generously for holding your cash. That is why your checking account might pay you essentially nothing, and a standard savings account pays only a token amount. Meanwhile, the price of everyday life keeps inching up, and if you ignore that math, you effectively volunteer for a pay cut on your idle cash every single day. So let's be brutally honest about the numbers. A typical checking account yields next to nothing. In fact, the average interest yield for a standard checking account is extremely low, currently around 0.07% to 0.08% at the time of recording this video. Now, sometimes it's so close to zero that the annual earnings on a few $1,000s wouldn't even cover your lunch. Standard savings at a big bank might pay a fraction of 1 cent. It's really not enough to matter, and it certainly is not enough to offset inflation. That mismatch is why the average saver feels stuck. You work hard to build an emergency fund, then the bank rents your money, invest it elsewhere while they toss you crumbs. So when the Fed trims rates, those crumbs shrink even further. If you do nothing, you accept less and less while the bank does better and better. The fix for this is not complicated, but it does require you to be intentional. There are two antidotes to lower deposit yields, and the first one that I recommend and that I personally use myself is one of the simplest ways to get a great return on your idle cash without taking unnecessary risk. And that's going to be short-term US Treasury bills, or T-bills. When you buy a Treasury bill, you're essentially lending your money to the US government for a short period of time, typically 1 to 3 months. In exchange, the government pays you interest, and these are considered some of the safest assets in the entire world because the US government has never defaulted, and frankly, they have a money printer. As of early November of 2025, T-bill yields vary by maturity. The 4-week bill is around 3.94%, the 3-month bill is around 3.89%, the 6-month bill is approximately 3.7%, and the 1 year is around 3.7%. Now, that's at the time of recording this video. This does change very often, so depending on the time that you're watching, this can completely change. These short-term Treasury yields are lower than the longer-term yields, like the 10-year Treasury note, which is currently around 4.1%. That's a very solid return for something that's virtually risk-free. The only problem, buying T-bills directly can be confusing for the average person. You'd have to go through treasurydirect.gov, understand the bidding process, and handle maturity dates. It's not impossible, but it's definitely not convenient. I do have a video about recreating a direct deposit where I show you how to buy T-bills, but the video, for all intents and purposes, is not really correlated with that topic. However, I will link the video here just in case you want to watch that. Here's where things get interesting though. You don't need to buy Treasury bills directly. There's a simple shortcut. There are ETFs, which are exchange traded funds that buy short-term T-bills for you. You just purchase the ETF like any regular stock in your brokerage account, and it handles everything automatically. The ETF I personally use is called SGOV. That's SGOV, and it trades just like any other stock on the market. SGov is managed by BlackRock, one of the largest and most reputable asset managers in the world. What SGov does is very simple. It invests 100% of its assets into short-term treasury bills with maturity dates under 3 months. Then, every month, it pays you the interest collected from those bills in the form of a monthly dividend. So that means you can earn around 4.35% annualized yield right now, completely passive just by holding SGov in your account. However, keep in mind that the yield on T-bills will go down as the Fed continues to cut rates. When that happens, SGov's dividends might shrink too, and you might go from earning 4.35% to 3% or even 2% depending on where rates settle. Now, let's discuss option number 2, which is a high yield savings account. These online accounts typically pay several times what traditional brick and mortar banks pay. They are still savings accounts, not investments. So that means the cash remains liquid, transfer times are very straightforward, and when you choose an FDIC insured option, you get the same federal protection as a standard account at a local branch. Let's run the math on a simple example. On $10,000, a standard savings account paying our standard 0.40% APY might generate $40 in a year, while a high-yield savings account near 4% generates roughly $400 for that same $10,000 deposit. So the difference is around $360. It's not a lottery ticket, but it is the cost of being passive versus being proactive. Over several years and larger balances, that gap compounds into a meaningful amount of money. There is a clock running though. After a rate cut, high-yield savings accounts tend to drift lower as well. Not always instantly, but gradually. So the earlier you migrate idle cash into a competitive account, the more of the current yield you capture before it steps down again. My selection criteria for a high-yield savings account is very straightforward. I look for an FDIC insured account with a consistently competitive APY. No monthly maintenance fees, no minimum balance that trigger penalties, and a smooth link to your main checking account. It helps if the provider offers a companion checking account and a debit card so you can easily transfer your money internally and access emergency funds without waiting days for an external ACH transfer to clear. Opening these accounts is fairly easy. Most applications take 5 to 10 minutes, and once you're approved, you can link your current bank account, initiate a small test transfer, and then move your emergency funds and any additional cash that you want to keep liquid. If you keep more than the FDIC insurance limit at one institution, you want to spread that cash across a second insured account. So the goal is very simple. Every dollar of your ready cash should earn the best risk-free rate that you can reasonably get. These are the top accounts that I recommend that you look at right now. One of the leaders in the space is Bread Savings. Their high-yield savings account is currently offering a APY around 4.20%, which is roughly 10 times what most big banks are paying currently. You only need a $100 minimum deposit to open the account, and there are no monthly maintenance fees whatsoever. The interest compounds daily and is credited to your account every single month, which means your money starts working for you immediately and continues to build momentum. Bread Savings operates entirely online, which does help them keep a low overhead and pass that savings back to you in the form of higher interest rates. Every account is FDIC insured up to the standard limit, giving you the same protection as most brick and mortar banks. For someone who doesn't need physical branches and wants to keep their emergency fund growing, this is one of the simplest and most effective places to park your cash. Another excellent option is SoFi's high-yield savings account. SoFi is known for combining convenience and innovation, and their bank platform continues that trend. By linking both a checking and savings account, you can earn about 3.80% APY, and for SoFi Plus members who set up direct deposit, that number can climb as high as 4.50% APY for 6 months. And of course, this promo is available at the time of recording this video and is subject to change. What makes SoFi stand out is the all-in-one system. You get both savings and checking in the same app, with no account or maintenance fees, no minimum balance requirements, and instant transfers between the two accounts. So if an emergency pops up, you can move your money from savings to checking within seconds instead of waiting days for an external transfer to clear. The account is FDIC insured through SoFi Bank, and eligible members can actually receive additional coverage up to roughly $3 million through SoFi's Insured Deposit Program. This setup makes it perfect for anyone that wants a high return but still values instant access to cash and a modern, user-friendly banking experience. The third standout choice right now is Barclays Tiered Savings Account. Barclays offers a competitive rate that can reach 4.10% APY for larger balances of $250,000 or more, while balances below $10,000 still earn around 3.90% APY. Like the others, there are no monthly maintenance fees, and in most cases, there's no minimum deposit required to open an account. Although Barclays operates entirely online, the interface is straightforward and easy to manage, and all accounts are also FDIC insured. One of the biggest advantages with Barclays is that it's especially friendly for savers who maintain higher balances, since the tiered system rewards you with slightly better rates as your savings grows. It's a great option for anyone who wants to keep a large cash reserve, earning strong returns without tying it up in certificates of deposit or market-based investments. Each of these accounts, Bread Savings, SoFi, and Barclays, represents a different style of banking, but they all share the same core benefits: safety, liquidity, and strong yields that far exceed what traditional banks are offering you today. The key takeaway is this: the sooner you move your idle cash into a competitive high-yield savings account, the longer you'll be able to lock in these rates before the next Fed cut pushes them lower. Even a difference of 1% in APY can mean hundreds of dollars in lost interest every year. So if you're serious about making your money work harder without taking on risk, this is your window, and I suggest that you act right now. I personally like to keep my cash flow in a mix of high yield savings accounts and the SGov, the short-term Treasury ETF, and when I'm between investments, this combination gives me peace of mind. My money isn't just sitting there collecting dust, it's earning steady returns through daily interest in a high yield savings account and consistent monthly dividends from SGov, all while staying extremely liquid and low risk. Now, this isn't some get-rich-quick approach. You're not chasing explosive growth here. You're protecting your capital and earning a respectable return while waiting for your next move. As interest rates eventually decline, both savings yields and treasury payouts will drift lower. That's just part of the economic cycle. But right now, this balance between a high-yield savings account and short-term treasuries is one of the smartest, safest ways to keep your cash productive without exposing you to unnecessary risk. Thank you so much for watching this video. If you've got extra cash that's just sitting around, whether it's in a savings account or just parked in a checking account, it's time to make it work. Neither of these options is set it and forget it forever, but together they make a powerful toolkit. You can keep your emergency fund in a top-tier high-yield savings account for instant access, and consider SGov for brokerage cash that you don't need same day but still want to keep very liquid and low risk. If this video helped you make your money more efficient, then please subscribe, like this video, and share it with a friend who's stuck earning 0.01% on their account right now. And again, thank you guys so much for watching this video. I truly appreciate it, and you guys have a wonderful day.